Okay, so let's take a look at Chapter 9. Chapter 9 is going to be looking at part of the balance sheet that deals with long-lived tangible and intangible assets. So the first part of this lecture video, we're going to talk about the concept or all the aspects related to just acquiring the tangible assets. So we'll be talking about the cost aspect, and then we'll get into the allocation of the cost aspect, which is of course called depreciation, or amortization or depletion. And then we'll look at a couple other issues like how do you dispose of assets? What if there's a change in accounting estimate when you change the estimate of the life of the asset? And then we'll look at the fixed asset turnover ratio. All right, so to start with, we'll talk about how you define, classify, and explain the nature. So typically there are what we say two types of long-lived assets, and these assets typically go for more than 1 year. You have the tangible assets and you have the intangible assets. The tangible assets obviously have a physical substance. They could be land, other assets that are subject to depreciation, such as buildings, equipment, furniture, and fixture. Now, of course, we'll get to land will be an exception later on, because we'll find out that even though it's a long-lived asset, land is one of the assets that we will not depreciate. Okay, and then of course on the intangible, you're going to get the things such as patents and copyrights and trademarks and stuff like that. And again, we'll talk about each one of those individually when we get there, and we'll show you how you deal with this. And of course, we'll have the cost aspect of it first, and then we'll deal with, we don't call it depreciation, but for the intangibles, we're going to call it amortization. But whether it's called amortization or depreciation, the concept is really the same. It's all going to be about cost allocation. All right. So getting to that cost, of course, the cost of these long-lived assets could be, of course, it's going to include the purchase price and all reasonable and necessary expenditures needed to prepare that asset for its intended use. And that could even mean training just to learn how to use the equipment, for example. But all these costs will be recorded as assets, and they call this, the concept is capitalizing. So the costs that go into the acquisition cost, it'll be termed later on, if you read about this and you come across that term, it's called, you're going to capitalize that cost and then put it initially on the balance sheet. So here's some examples of different types of costs. You got land, of course you have the purchase price, legal fees, survey fees, title fees, and some of these are going to be the same for each category. Same thing with buildings. You got purchase, sometimes construction costs, again, legal fees, appraisal fees, architect fees, and again, the same thing with equipment. You got purchase price, construction, you might have to pay sales tax, and of course, anything that you're transporting, installation. In this example, they're showing you a roller coaster over at Cedar Point, or I think it's Cedar Fair, and of course, all the costs that would go into capitalizing the cost of that long-term asset. But again, these are your tangible assets. Sometimes you might have a situation where you might purchase some tangible assets in what they call a basket purchase. Like you might buy the land in the building in one purchase. So in this example, they say, what if you purchased land in a building and the cost was $400,000, but the appraised values for the building were $325 and the land was $175. So we got to figure out of that 400, how much of it are we going to allocate to land and how much to building? Because remember, with the land, we don't depreciate land, but building we do. So we have to actually separate that cost and divide it between these two. So what you do then, the next slide, is you just simply take a ratio of the fair value. So you got land and building, total is 500,000. So the percent or the relative value of land to the total is 175 divided by 500, which is 35%. And for the building, it'd be 325 over 5, which is 65%. And then you just take those two percentages and multiply that by the total purchase price. And that would be how much you're going to allocate to each category. So land would get 140 and building would get 260. And then those would be recorded as the capitalized cost on the balance sheet. Okay, in this example, you've got, again, this is Cedar Fair. This is where they're buying this roller coaster. Total cost is $26 million. They got a discount. They had to pay transportation costs and installation. This was the maintenance people installing. So to show you how you would prepare a journal entry for this acquisition, assuming they also had a note, they had to sign a note for the new roller coaster, so they didn't pay for all of it, but they're just going to pay cash for the transportation and installation. Let's show you how that would work. So again, up in the top part, this is going to be the total cost of the roller coaster. They divide and they divide all these into these categories, and they subtract the discount. You get the total cost of the roller coaster. So that's going to be debited, of course, to equipment. And of course, the cash is just the installation and the transportation. And then the note payable is going to be for $25 million. So if you notice, you got a total cost debit of equipment for $25,750. You credit cash for $750, and then the difference goes to $25 million, goes into that note payable. So that's how you would actually record it on your journal. Other issues that could come up other than the acquisition cost is, sometimes you could have what they call maintenance costs. And if it's an ordinary type of an expense or repair and maintenance, the accounting treatment is going to say that you're just going to expense those type of items. You don't capitalize those. So again, these would be things that are relatively small, recurring normal maintenance. It doesn't increase the productivity and does not extend the life of the asset. So as long as it's an ordinary repair, you just expense those. The extraordinary repairs typically are large items. You don't do it very often, very infrequent. It could be a major overhaul or replacement, like maybe you replaced an engine to a truck. It could extend the life and increase productivity. Those types of costs you'd have to actually capitalize and put those on the balance sheet. So there's two types of expenses or expenditures that you can encounter. Some are just ordinary, which you expense, and some that are extraordinary, which you would then capitalize. All right. So once you've got the cost, then the next aspect will be to allocate that cost. So for the tangible assets, we call that depreciation. And of course, some of you would have known about this from your applied accounting class. So you take that acquisition cost, you allocate that cost to the income statement as you use it, or in the periods that it's benefited, because this is that matching principle. You want to match the expense or the cost to the period that it benefits. So again, you got depreciation expense that we're going to have to calculate in a moment. And then of course, that's going to go on the income statement. And then the way you reduce that allocation or that cost on the balance sheet, of course, you never change the cost, but you have an account called the accumulated depreciation. And that just keeps track of everything that you're allocating. And that's a contra asset, and then that's going to be also put on the balance sheet to update the book value. So in this example, it says, what if we had $125 of depreciation, just to show you how that affects the accounting equation and the journal entries. So again, accumulated depreciation, which is a contra asset, would be a negative. It's going to reduce your assets. And then here's your depreciation expense, which of course would reduce the equity. The journal entry would be debiting depreciation expense and crediting accumulated depreciation for 125. All right, so then to kind of show you again where this goes, again, here's on the income statement, you have depreciation expense, which is going to show up as an operating expense. And then on the balance sheet, here is your book value. So book value, again, is your cost. Subtract out the accumulated depreciation, and that's called your book value. 1,510 is book value. So you need to know that relationship or that formula and how to calculate, again, book value. Okay, so once you get in the hang of it, the basic idea of depreciation, there are actually different methods and different treatments in terms of methods you can use to actually do the depreciation. So three of the methods, there's actually more than three, but three of the methods that we'll be discussing in this book are called the straight line method, units of production, and declining balance. And of course, a lot of you probably have already remembered a straight line method that you would have done in your applied accounting class, which was again the prereq to take this class. So again, back to this example we've got at the beginning of the year. Get Cedar Fair purchased a new go-kart ride for $62,500. So they're just going to summarize the cost into one number, pretty easy. We just want to deal with the cost allocation aspect of it. Since the ride has an estimated life of 3 years or 100,000 miles and an estimated residual value of $2,500. That means at the end of 3 years, they're estimating that they could scrap it or sell it for $2,500. So that's just called your residual value. All right. So the straight line method, pretty straight, no pun intended. The format is you take the cost, subtract out that residual value, and then divide by the useful life. And of course, useful life is it in years or months. You have to watch your time periods in terms of what the problem is going to be asking for you. In this example, they want the depreciation per year, so we're just going to be dividing by 3. So here's your cost, here's your residual value, you subtract, they call that your depreciable base, and then either divide by 3 or multiply by 130, the way it's the same thing. You're going to get $20,000 of depreciation expense per year. So this little box is telling you this is what your yearly depreciation is. Notice your book value, starting at $62,500 is your initial book value. Notice that your book value will go down each period or each year by your accumulated depreciation, or basically every year it goes down by $20,000 until you get to that last year. Notice that the book value should always equal the residual value at the end of the life. So notice the residual value is $2,500, and following this formula, you will get a book value right at $2,500 at the end of its useful life. And all the methods will attain and try to get to that estimated life at $2,500, or the residual value of $2,500. The units of production method is very similar to the straight line method. You take your cost minus residual value, that's the same, but then the depreciation rate's different. So the way you do that, you don't divide by the estimated life in years. It's really, you look at the rate in terms of what they're using. So the problem said the ride at 100,000 mile life. So what you do is notice that's the base, that's the denominator, and then each year you just have to keep track of how many miles you use. So in the first year, if they use 30,000 miles, you simply take 30,000 divided by 100, which is again 30%, multiplied by that cost minus residual value base, and that will give you your depreciation expense. So that's how the units of production method works. And again, here's the table again showing you, again, notice that your base stays the same, but each year they're multiplying by a different rate depending on what they use. So it's more of a cause and effect type of formula. Again, notice book value always ends at the residual value. All right, now under the declining balance method, this method is based on your book value. So notice you don't take cost minus residual value, you take cost minus accumulated depreciation. That's going to be your depreciable base. And if it's declining balance method, it depends on what they're wanting you to do. In this example, it's double declining balance. So double declining balance is simply 2 in the numerator divided by the estimated life. So in this example, the estimated life was 3. So 2 over 3 would be your rate. If they had said the estimated life is 5 years, it'd be 2 over 5 and so forth. So 2 over 3. So notice you got 62.5 times that 2/3. That would be your depreciation in the first year. And then in the second year, again, you have to update that base. You take the cost minus the accumulated depreciation, and then still multiply by that same rate, and then you get 13,889. So that's the basic idea how you do it every year. Now, the thing about the declining balance method is you got to make sure that that ending book value always equals the residual value. So in this example, you got the first 2 years where you're following the formula, okay? And then you get to this book value in year 2. Notice you got 69.44. If you plug that in to year 3 and multiply by the rate, you'd get 46.29. That would actually give you a book value that's less than 2,500. So the general rule is once you get to the final year of your declining balance method type of issue, you basically just plug the difference. You just force that book value to equal the residual value. And so you always have to watch the book value in this method compared to what you're depreciating to make sure that that book value does not go below the residual value. If you get to a point where it does, you simply just stop and you'll plug the difference to force that book value again to equal the residual value. And then the next slide again is just showing you a comparison of the straight line, the units of production, and the double declining balance method in terms of how the depreciation expense would compare each year. Notice in total it's the same, but depending on each year, it could have an impact on your financial statements. So remember, depreciation expense affects income. So this could affect how much tax you pay. It's going to affect your profits. On the balance sheet, could also affect some of your ratios on your assets because accumulated depreciation affects some of your asset ratios. So depending on which method you use could impact the financial statements each year, and individually, yearly, how you're interpreting what's happening at the company. Other issues that might come up, these examples showed you full years. Sometimes you might have an asset that was acquired during the year, so therefore the depreciation will be calculated for a fraction of that year, depending on when you first started. Remember, everything doesn't always start on January 1. So just kind of keep that in mind, what they call it's called like partial year depreciation. Calculations are the same. You just have to take in the fraction of the year that you're using it. Other issues could come up. You have, of course, tax issues. And remember, in this class, we follow GAAP. And for income tax reporting, you got to follow the IRS code. And notice there's actually two different objectives. For financial accounting, we provide economic information about a business that's useful in projecting its cash flows. Notice the objective for the IRS is not the same. Their goal is they want tax revenue. They want to raise sufficient tax revenues to pay for the expenditures of the government. So therefore, because we often have different objectives and different goals, the GAAP rules do not always align with the IRS code. And because of that, that's why a lot of companies have to have two sets of financial records. And they would have financial records according to GAAP, and then they'd have financial records according to the tax code, because again, they got to follow the appropriate code by the federal government. All right, other issues that could come up, again, this is still dealing with the tangible assets, is you could have asset impairment. And asset impairment is looking at what they call the estimated cash flows generated from the assets, from those long-lived assets. And sometimes this impairment is when these future cash flows fall below their book value. This could be because of casualty or obsolescence, a lack of demand. And if this happens, notice you have to actually recognize a loss when you feel like this impairment is deemed to be permanent. So there's two steps when you actually have to account for it. You have to get rid of the accumulated depreciation, and then you got to write down the asset to its worth, to its fair value. All right, so in this example, just to kind of show you, they have an impairment loss of 8.6 million. So they looked at their cash flows and they determined what that value is. And generally speaking, there would be some present value, some time value calculations involved here. So just for simplicity for this class, they're just going to give you how much has been impaired. You just have to know how it's treated. But if you took like intermediate accounting, they would actually show you how you came up with this 8.6 million. All right, so you got the Shooting Rapids ride, it had a cost of 10.6 million. And then they closed it in 2015, so they opened it in 2010. The ride closed in 2015. They had accumulated depreciation of 2. So the first step, notice, was to net the 2 million, that's the accumulated depreciation, against the equipment. So notice they have, they'd be crediting equipment and debiting the accumulated depreciation for that 2 million. That would be your first step. And then notice, after you do that, so the asset account showed again, it had a book value of 8.6 million. The second step, you have to write down that balance to their fair value, which in this case, you're assuming it's worth 0 or nothing. So essentially, at that point, you'd be debiting an impairment loss. It basically is going to go on your income statement just like an expense. It's going to reduce your profits. And then you're going to get rid of that equipment off your books by simply crediting the equipment. So notice you'll reduce your assets. And of course, you're going to be reducing your equity as well. All right, so once you've done that in some cases, then you may need to do a disposal of these long-term assets. This is when you get rid of it. So again, when you do this disposal, you need to update all your depreciation. So basically update your book value and then actually record the disposal. So notice you have some entries here. In this case, if you're getting some money from it, you're scrapping the material, or you found a buyer, you might have cash. You'll be debiting accumulated depreciation, crediting equipment, and then depending on if it is cash being received, if you get more cash than the book value, you could have a gain. If you get less cash than the book value, then of course you're going to have a loss on the sale. And the next slide just shows you simply that. If, again, just to go down to the last line, a loss would occur if you receive less cash than the book value. Okay, so in this case, we're going to walk you through a disposal example. And it says that, get my stylus back on. It says they sold one of their smaller junior roller coasters. They got $50,000 cash at the end of its 6th year. They got the original cost. It was being depreciated using straight line method with no residual value for 10 years. So just to keep it simple, it's been used 6 years. So we got 6 years of depreciation that we need to update. So the first question is, what's the amount of depreciation per year? Of course, you got the cost, and then simply you're just going to be dividing by 10. So you know it should be $10,000 per year would be your yearly depreciation expense, and it's going to show you that right here. Again, this is using straight line method, cost minus residual value, divided by 10 would be $10,000 per year. Now, to figure out the book value at the date of sale, you have to update 6 years of depreciation. So if you got 6 years of depreciation, that's 6 times 10,000, that's 60,000. So 100 minus 60, you would have a book value right now of 40,000. So then the next thing you're going to do is you're going to compare that book value to how much cash you're receiving. And in this case, they've got $50,000 cash. If the book value is 40, of course, you're going to have a gain of $10,000. This is a case again where you got more cash than the actual book value. All right, so at that point, the way you would record the actual entry, you'd be debiting cash for 50, debiting accumulated depreciation for 60, because that's what the accumulated depreciation was at the date of sale, crediting the cost of the equipment, and then that 10,000 is just a plug number to make the debits equal to credits. But notice that's the gain. And of course, here shows you how that would be affecting the accounting equation by reducing your asset. You got a negative 100 equipment, a plus 60 to accumulated depreciation. So this gets rid of the book value. Here's the increase to cash. And of course, there's going to be the gain on disposal. All right. So now that we've dealt with tangible, then you also have the concept of the intangible. Again, intangible assets typically, again, are more than a year. So again, they don't have any physical substance. That's one of the characteristics. It could include such things as exclusive rights or privileges. There's usually a useful life, but sometimes that life can be often difficult to determine. So there's some standards that we'll be looking at. And usually you have to use these some cases for operational. So it could be like a patent or trademarks, stuff like that. Okay, so just the basic types of things in terms of cost. Again, you could have the purchase price. You could buy a patent. You could buy an invention. You might have to file legal and filing fees, and all those things would be relevant to figuring out the cost of that particular intangible assets. Notice it says we're going to be amortizing these, not depreciating, but amortize is the term used for intangibles. But you're going to amortize these intangibles with limited lives over, this is key, over the shorter of their economic life or legal life using the straight line method. So sometimes the economic life is going to be shorter than the legal life. In that case, you would divide it over the economic life. So we'll get to some examples. You have trademarks, copyrights, with some of these things you may have already known about. But again, you got the trademark, which is some sort of symbol, design or logo, kind of like the Nike symbol. You could have internally developed trademarks. That's kind of interesting because those you don't have any sort of cost other than possibly some legal fees for filing it. But you could also purchase it as well. If you purchase an entity's trademark, you of course would record it at cost. Copyright, again, is the exclusive right granted by the federal government to protect your artistic and intellectual properties. This is really, really big in the music industry when people are trying to steal music. The treatment is you amortize it as the legal life is the life of the creator plus 70 years. You amortize the cost over the period benefit. So it's still that same matching principle concept you do with depreciation. Patents and licensing rights, again, patent is the exclusive right, again, to either sell or manufacture an invention. Notice you amortize it over the shorter of the life or 20 years, so no more than 20 years. So essentially, if you invent something that's pretty cool and you can make a lot of money on it, you get the patent on it. Only you can make that thing. You got 20 years essentially to max out your profits. Once that 20 years hits, then everybody else copies it. Think of the concept of certain types of drugs and allergy medicine. You have brand name stuff, and then once those patents run out, the generic drugs are always cheaper than the brand name drug because once these big companies start to produce them, they can do them at a lot less price, and that's why it's always cheaper to buy generic. But the 20 years, you got 20 years to make your money, and then at that point, other companies and businesses can copy you. All right. These licensing rights they're granted, again, limited permission to use that over these specific terms and conditions. All right. All right. So we've got our intangibles. And then I think, is there one more we want to talk about? You could have, technology assets like software as well. And of course, franchises. And we won't deal specifically too much with franchises. You'll get more of that in some of your upper level accounting classes. But typically, usually it's up a shorter time period. Usually those are 3 to 7 years. A franchise provides legally protected rights to sell products or provide services purchased by a franchisee from a franchisor. Okay. So you can read about that. And then of course, there's one more big one, which is called the goodwill. And goodwill can only happen if you buy another company. So when you buy another company, whatever you pay over the fair value of the net assets acquired, that's how you create goodwill. You don't amortize it, but it has more of a write-down treatment where you do an impairment test every year. So that's going to be a different story. But just with the concept of goodwill, it's an intangible. It can only happen when you buy another company. Okay, so again, amortization typically is a straight line approach. In this example, it says they purchased a patent for an uphill water coaster, cost $800,000. They intend to use it for 20 years. As each year, the company will record $40,000 in amortization expense. You just divide by 20. So notice they've got accumulated amortization, just like depreciation works the exact same way. And then there's your expense, and notice you debit amortization expense and credit accumulated amortization. All right, and again, here's just a summary of the accounting treatment. You can kind of go back and review this. Typically, if you got your tangible versus intangible, you can comparing them. You have repair and maintenance. Notice that's not applicable to intangibles because those aren't physical. But the depreciation treatment, you could have several methods for intangible. For intangible, typically you go with straight line method. And then you've got unlimited life type of issues. That's with land. obviously, for the tangible assets. You have impairment. Sometimes you write down for both. But notice the one thing that you do not, under each category, you have two specific unique items. For tangible, you don't depreciate land, and for intangible, you do not amortize goodwill. But you do write down impairment test on goodwill, so that's a different story. Okay, next up, we have what's called the fixed asset turnover ratio. Pretty simple calculation. This is just, taking your revenue, your net revenue, divided by your average net fixed assets. You're just measuring how much money you're generating by each dollar of amounts that you've invested in your fixed assets. So it's essentially a company who has these big fixed assets to help generate revenue. And this comparison is just trying to show you how much you're generating from these net fixed assets. So in this example, you have your revenue. They got your end of year fixed assets in the beginning of the year. You just have to average them. And then when you divide, the next slide will show you the calculation. So notice you just have some turnover ratios to look at. And of course, the real analysis would come when you compare these fixed asset ratios, maybe among different competitors or certain benchmark standards, to figure out how well are they helping to generate revenue. All right. Some other things to look at. Of course, you have the impact of depreciation differences when you have, using these different methods. And notice you've got, it says the accelerated depreciation. Of course, that would be the double declining balance method. Obviously, it's going to affect your depreciation expense. You're going to have higher depreciation expense, lower net income in the early years. Typically, if you're selling an asset with a low book value, it could result in, of course, a gain. Selling the same asset with a higher book value might have a loss. So there's different impacts, again, like they showed you earlier, in terms of how your financial statements are affected, because the straight line method, declining balance method, units of production, they all give you different yearly depreciation expense amounts. So that could have impacts, again, on all your financial statements and, of course, your fixed asset turnover ratio. All right, a couple more things. You might also have natural resources like land. A part of your land, you might be mining coal or copper. And notice they like to use the term depletion. You don't use amortization, but they use the word depletion. But the calculations are very similar to the straight line type of approach, to the units of production approach. And you got to figure out exactly how much you've depleted. But if you ever read about the depletion of natural resources, again, you have to allocate that cost, whatever that natural resources cost, again, over the period that you're actually extracting. So it's very similar to that, again, units of production approach to come up with that actual allocation. I think the last thing we'll deal with before we get to some of the problems is, because these methods with depreciation involve estimates, sometimes you could have a change in an estimate. And there's an accounting treatment if you change the estimated useful life of an asset. And so, I mean, this could happen typically, something could revise, new information could come up. It could indicate that the original estimates need to be revised. That revised could either mean maybe longer, maybe shorter. But remember, because we are using estimates, sometimes these estimates could change. So if you ever get something like that, like in this example, we've got where Cedar Fair purchased some equipment that cost $60 million, estimated like 20, and estimated salvage value of 3. And then after the start of the 5 year, they changed this estimate to be 25 years and lowered the estimated salvage value. So something came up where they figured the life is actually a little bit different than what they initially estimated. So they want you to calculate the depreciation expense for year 5, and thereafter using, again, how would that work using the straight line method? So typically what you need to do, it's all based on your book value. So you start with the book value at the date of change. That's going to be your first calculation. And then you subtract out any residual value at the date of change, and then divide by the remaining useful life. So in this case, just showing you the calculations, they figured out the accumulated depreciation at the end of year 4. They updated the book value. So notice this book value is your starting point minus the new residual value. And then they multiply this by 1/21 because in this case, If the remaining years left, there's still 21 years left. So that would be a revised depreciation moving forward. Okay, guys, I think that's it for my comments about chapter 9. And everything else that we'll look at in the upcoming videos, we'll be looking at some individual exercises and textbook illustrations.